The big one is really coming. Following the most significant interest rate cut of the year, it seems a global bull market has begun. All three major U.S. stock indexes have reached new highs, and global capital has poured into the stock and bond markets. Even commodities and cryptocurrencies are volatile. But, friends, this is just the beginning. The market's biggest excitement isn't about the one rate cut, but rather Morgan Stanley's announcement. Morgan Stanley is Wall Street's most prestigious investment bank. The Federal Reserve will cut rates 3 more times. It's like a four-act play. The fireworks were set off in the first act, but the final 3 acts will determine the outcome. Today, I'll break down the playbook for the next 3 interest rate cuts and explain how they will occur. How will the stock market transition from a period of emotional euphoria to a major bull market that will propel certain sectors higher? Which sectors will rebound after the initial surge? Which sectors will emerge as true winners amidst market volatility? When should you invest in which sector for the highest returns and lowest risks? Remember, this isn't a classroom lesson, it's a battle map for your wallet over the next 6 months. I hope you'll thoroughly review my analysis so that you can hold on to your investments with even greater conviction. While some may simply cheer on the news, you already have the playbook for the next 6 months and are poised to embrace the true bounty of wealth. Hi, I'm Daryl Hart, a blogger who loves talking about financial gossip. When the Federal Reserve delivered its blow of interest rate cuts, the market erupted like a tinderbox. Funds poured into the stock market like an unstoppable flood. In this frenzy, however, it was always the technology and AI sectors that captured the most imagination and took center stage. Why them? Because they were the hungriest diners at this low-interest feast. Unlike traditional industries, these emerging companies lacked the stable cash flows of established businesses. Their value rested entirely on the boundless possibilities of the future. The interest rate cut acted as a shot of adrenaline for these dreams of the future. The sudden drop in financing costs instantly inflated their valuation models, sending them soaring into the sky like a deflated balloon being inflated. The first act was an emotional spectacle. No one cared about immediate profits, only future stories mattered. Keywords like chips, computing power, and AI models were the sparks that ignited passion. Imagine it as a grand fireworks display where the opening must be powerful enough to captivate the entire audience. This scenario has played out repeatedly throughout history. For example, in 2019, after the Federal Reserve's initial rate reduction, the Nasdaq increased by over 6% within a month. In 2020, amid unprecedented interest rate cuts and monetary easing, tech stocks were the first to reach new heights, far surpassing the broader market. This momentum stemmed from the hysteria of a bull market. In just a few weeks, capital rushed to embrace technology and AI at all costs, propelling them to center stage. During this period of emotional euphoria, it's important to distinguish between hardware and software. Hardware first, chips and computing power form the foundation of AI infrastructure. Increased capital expenditures driven by interest rate cuts will first be reflected in orders from these hardware companies. Companies that provide high-end GPUs and AI chips, for example, receive orders representing real money. Software lags behind. AI model and SaaS software as a service companies take longer to become profitable. Their initial gains are driven primarily by expectations. If performance fails to keep pace, the correction will be severe. But how long can these dazzling fireworks last? Typically, the show ends after about a month. As the emotional climax fades, rational voices begin to emerge. The story is great, but where are the results? At this point, the market calms down and examines whether AI orders are actually being placed and whether cloud computing spending is delivering results. If performance doesn't keep up with the hype, the frenzy will quickly cool, leaving behind a sea of sparks and a mess. As the tech fireworks gradually fade, smart money begins searching for its next target. They ask themselves, who else is undervalued? Which companies will suddenly have impressive financial statements amidst continuous interest rate cuts? The answer points to those overlooked sectors: real estate, utilities, and REITs. This second act wasn't as dazzling as the first, but it had much greater endurance. It was like a slow-burning fire. It lacked instantaneous explosive power, but it consistently warmed the market. This power stemmed from 3 core principles: declining mortgage rates and a recovery in the real estate sector. The Federal Reserve's excessive interest rate cuts have significantly lowered monthly mortgage payments. This is great news for homebuyers. As demand begins to recover, valuations in the real estate sector are naturally recovering as well. Revaluation of utility cash flows. In the era of high interest rates, stable utility dividends were unattractive. However, after the rate cut, these stable cash flows suddenly became valuable again. They're like forgotten antiques whose value suddenly doubled during a collector's craze. REIT financing has been revived. REITs' lifeblood lies in financing. During periods of high interest rates, their financing channels were virtually blocked. Following the rate cut, financing costs plummeted, making REIT asset returns and dividend yields attractive again. It's as if a long dormant giant has been reawakened. Historical experience demonstrates that real estate, utilities, and REITs usually lag behind the tech sector in terms of growth. During the 2019 interest rate cut cycle, real estate and utilities took over after a month of tech-led gains, outperforming the broader market. Why? Because the market needs time to confirm that rate cuts are part of a continuous easing cycle, not just a one-off test. Only when the second cut arrives will the market truly believe it and begin to embrace these catch-up sectors. This slow simmer often lasts longer, extending over 2 quarters because it's based on solid ground, not emotion or imagination. However, this scenario carries risks. If inflation becomes too persistent and long-term interest rates rise again, the cost advantage of the real estate chain will erode. If employment data deteriorates, demand for home buying could decrease. When investing at this stage, you should pay attention to leverage. You should also pay attention to cash flow. Real estate. Focus on leading developers with moderate leverage and substantial land reserves in major cities. These sectors have the greatest potential for valuation recovery because interest rate cuts will directly reduce their financing costs. Utilities. This sector is characterized by stable cash flow and low volatility. Select utility companies with high dividend yields and stable growth expectations. They will become increasingly popular during interest rate cut cycles. REITs. Focus on REITs with high-quality asset portfolios and stable dividends. Interest rate cuts directly reduce their financing costs, enabling them to optimize their capital structure through refinancing and increased dividend returns. As the slow burn of the second act continues, the big fire that will ignite the entire economy is about to emerge. Industry, manufacturing, and infrastructure are the most solid foundation of this bull market. Why are they always the last to take off? It's because they rely on tangible orders and capacity utilization, not vague expectations. Interest rate cuts merely provide them with cheap fuel, whereas the real fuel comes from fiscal spending, infrastructure projects, and corporate expansion. You can think of them as heavyweights who only push the door open once the party is in full swing. Historical data strongly supports this. In 2019, for example, the industrial sector didn't gain significant momentum until after the second rate cut. During the rate-cutting cycle from 2001 to 2003, manufacturing stocks also lagged significantly. Once they get going, however, they can stage a major multi-year rally fueled by capacity, orders, and fiscal spending. Once accelerated, they become unstoppable. This roaring bull market typically begins around the third rate cut within a 70 to 120-day window. Several key conditions converge at this point: cheaper corporate loans, infrastructure project approvals, and the PMI index returning above the boom-bust line. These three forces intertwine like turning on the main switch of a huge machine, and it roars instantly. This rally is the longest lasting, often lasting 6 months or more. This is because it's not just a sector-wide rally. It's a systemic bull market that drives the entire economic chain. However, there are pitfalls. If inflation rebounds, industrial cost pressures will rise rapidly. If the fiscal deficit widens, infrastructure spending could become difficult to implement, and if external demand weakens, the startup of industrial production could be delayed. During this phase, the investment logic shifts from anticipation to realization. New infrastructure. Compared to traditional infrastructure, new infrastructure, such as data centers, smart grids, and renewable energy, holds greater potential. These sectors benefit from fiscal spending and are closely tied to technological and industrial upgrades. Industrial automation. Interest rate cuts will encourage companies to expand production. Companies that provide industrial robots, automation equipment, and smart manufacturing solutions will experience an increase in orders. After the three-act drama concludes, the bull market enters a plateau phase. During this phase, the market isn't necessarily bad, but it will become more complex. Why? Because after 3 consecutive rate cuts, The market has already anticipated the easing. The subsequent rise must therefore be supported by realized profits. So, who will survive? The answer is a dual-core bull market. Throughout history, only two sectors have remained at the center of the stage at the end of each consecutive interest rate cut cycle. Category 1. Technology leaders. They can convert liquidity dividends into real free cash flow. Can AI concepts be translated into real orders? Can data center spending be reflected in financial reports? This is the turning point. Category 2. Consumer staples and healthcare. After three interest rate cuts, the market will worry about resurging inflation. At this time, stable and in-demand sectors become the ballast. These are the industries where, no matter which way the wind blows, you have to spend. Therefore, during the plateau phase, the bull market is no longer characterized by widespread flourishing. Rather, it has a dual-core structure, tech leaders that can deliver, and consumer staples and healthcare that can hold up. Now comes the question, friends. Now that the three-act drama is over and the plateau phase has begun, which sector should you bet on? History has taught us that winners who can tell a story and deliver on it ultimately prevail. But right now, the market's clamor is driving everyone into a frenzy. Can you tell the difference? Would you rather be a spectator watching the fireworks or a winner with a script?